Hi, thanks for joining us for another video. Today we're going to be going over the 5 top questions you always want to ask hard money lenders before getting a fix and flip loan. So the very first question I always ask when approaching a hard money lender is what their LTVs are and their max loan amounts. So we'll just start there. Number 1, max loan amounts. Now the max loan amounts are going to be expressed in a ratio and a percentage. So normally the max loan amounts that hard money lenders are going to give you are going to come in the form of either the ARV or the LTC. So ARV. ARV stands for after repair value. And what the lender is going to tell you is that they max out at a certain percentage of the after repair value. Most commonly, you'll hear it around 75%. So what that means is if your after repair value is $100,000, for example, the lender is saying we max out at 75% of your after repair value, which in a $100,000 example would be $75,000. Now the other expression of max loan amounts that a hard money lender is going to tell you that they go up to is the loan to cost. And that stands for that's LTC, loan to cost. And what that means is the total loan amount to the total cost. So what they'll normally cover is around 90% LTC, which means if your project costs $100,000, they'll cover 90% of that, which would be $90,000, right? So typically you're going to see 90% loan to cost. Now the reason why this metric is so important to start out with when you're talking with your lenders is because you want to know how much money that you can get for your project. And a lot of lenders are going to say, hey, we will either go max 75% ARV or max 90% loan to cost, whichever is lower. So before you start working with the hard money lender, before you get that loan, you always need to know what your max loan amount is so that you know how much you can borrow for your project. So that's the very first question you guys want to ask every single time. First thing you should ask is, what's my max loan amount? So you have an idea of how much money you're going to be able to get for your project. Moving on, the second big question you're going to want to ask is, what type of lender are they? Are they the direct lender or are they a correspondent? So number 2, direct or correspondent. So this is something that most people don't really understand that's even out there. It's weird, you know. Only if you're really an insider in this industry will you know whether or not a lender is a true lender or if they're a correspondent. And now the difference between direct lender versus correspondent, direct lender is the source of funds. That's where the funding is coming from. They are the ones actually lending you the money. Some lenders, though, are able to act as a correspondent lender, which means sometimes they do lend their own money directly, but other times they just correspond as the originator of loans for a different direct lender. And so what happens with this is you're going to see a lot higher fees. You're going to see a lot of fees added up, or you're going to see origination fees that go from a typical 2 points that a direct lender would charge to about 4 points, which would show from a correspondent lender. So you always want to ask the lender, and they need to be honest with you on whether or not they're a correspondent or a direct lender. And a good way to tell, again, is going to be to look at the fees. If there's a lot of underwriting fees and exorbitant amount of points added onto the loan, that's when you're going to know, okay, this might be a correspondent lender. It's time to move on and try to find a better source. I'm not saying it's bad to work with correspondent lenders, but what I am saying, the fees are going to be a little bit higher. They're essentially acting as an originator or a broker for a direct lender. So that's a good question you always want to ask. Who are you actually working with? Are you acting with the direct lender or the correspondent? Now moving on from that, we do have a third question, and it came up in our last explanation. Points and fees. So if you're not familiar with what points are the origination points that are charged on your total loan amount. So what that means is 1 point normally equates to 1% of your loan amount. Now points are paid up front, and so that's money you have to come to the table with for the origination of the loan, right? So these are upfront points. It's money out of pocket that you have to come to close with. So you always want to know what your points are going to be, as well as fees. So there's all kinds of fees: underwriting fees, processing fees, packaging fees, credit report fees. It goes on and on and on. So before you really, before you decide to get to the signing table or submit documents to the lender, definitely before submitting documents and wasting any time, you need to understand how many points you're going to be paying up front and how many fees you're going to be paying, just to make sure your project's going to be feasible and you're not getting, you're not losing too much margin in these fees. Next, fourth one we're going to be going over. Just check my notes here. Contractor required. Oops. So, is a contractor required? Super important. When you're doing a hard money loans are in essence loans that are given by private lenders. And if you're using that money for a fix and flip or a construction loan, you need to know before you get into debt whether or not you need a general contractor on site. Some lenders require general contractors, others do not. And it also is going to depend on the type of project you have. The lender needs to feel comfortable that you're going to handle their money wisely, and you're not going to be putting money into a project that's going to inevitably fail. So a lot of lenders might not require general contractors on most deals, but when it comes to highly complicated deals with a lot of ground-up construction, that's something that they may just require a general contractor on. So you need to know before submitting any paperwork whether or not with your specific project if you're going to need a general contractor or not. So always want to know that before you get into anything, right? So make sure you know this before you get into the project, and then you find out you can't draw any money, you can't use any money until you actually get a general contractor. So make sure whether or not you need a GC. Now finally, number 5, the one you guys have all been waiting for. Well, I think that's it actually. Oh yeah, that's right, draw schedule. Draw schedule. So if you're not familiar with these types of loans, with a hard money loan for a fix and flip, they're going to give you 2 disbursements, 2 major disbursements. The first one is going to be for the purchase. So a lot of lenders will say, hey, we cover up to 90% of the purchase price. You just have to come with 10% to the table. That's going to cover the purchase of the property, right? Now, after that, you're going to say, well, I need money for the rehabbing of the property so I can sell it for more, right? And the lender understands this. So they say, okay, well, this is what your draw schedule looks like, okay? So you want to make sure you understand what the draw schedule is. Now, draw schedules, some lenders will say, okay, we will give you 3 draws, a maximum of 3. So that means that you have to get all your project done within 3 draws. Or sometimes they'll tell you, listen, you can have as many draws as you want. Now, every time you draw, though, we're going to send an inspector out. Now, that inspector, it's going to cost you. Normally, that fee is around $200 to like $300. So you want to understand the draw schedule that the hard money lender has for you before getting into the loan, before submitting any paperwork, to make sure the draw schedule is going to make sense. Now also, one key point that I do want to leave you guys with, when you're getting a hard money loan from one of these fix and flip lenders, draw schedules normally get paid out in a reimbursement. So what this means is they're going to lend you money for the initial purchase, but they're going to allow you need to pay for the rehab, and then the money that they're going to give you from the draw schedule goes to reimbursing you for the money you spent for the rehab. So you need to make sure that when you get into a deal that you have enough money not only for the purchase, but also for the rehab portions, because you need to come out of pocket for those rehabs, and then most lenders are going to reimburse you with those draws. So you draw money again, you work on the property, and then you draw money again, and then you work on the property. And some lenders will let you do as many as you can. Others have a few, 3 or 4 or 5 draws that they'll let you do. So anyways, you want to make sure you understand the draw schedule, the fees associated to making a draw, and then also whether or not they're going to reimburse you for the work that you do on the property, or they're going to give you the money up front for the work you do on the property. Super important before you submit anything, before you get the loan, you need to understand the draw schedule. So I hope that helped you guys today. 5 important questions you need to make sure you're asking your lenders before wasting any time with any of the wrong people. Thank you so much for watching, and I'll see you guys in the next video.